Hi guys, welcome to my YouTube channel. If it is your first time here, let me introduce myself. My name is Sheila. I am a data scientist and I decided to create this YouTube channel to share my knowledge about financial markets, data science, and quant analysis. And today we're going to understand the Dow Jones Index, the most important index in the world. Have you ever heard someone say the Dow Jones was up today or Wall Street closed at high? But what exactly is the Dow Jones? Does it represent every company in the United States? Let's find out. The Dow Jones Industrial Average, often called simple the Dow Jones or the Dow, is the one of oldest and most well-known stock market index in the world. It was created in 1896 by Charles Dow and Edward Jones. Its original purpose was simple to measure the performance of America leading companies. At first, the index included only 12 companies. Today, it tracks 30 of the largest and most influential public traded companies in the United States. These include well-known businesses such as Apple, Microsoft, Coca-Cola, McDonald's, Goldman Sachs, Visa, Walmart, IBM, and many others. Other companies come from a variety of industry, make the index a useful indicator of the overall health of large USA corporations. So, why is the Dow Jones still so important? Because it includes some of the most established and respected companies in the world and remains one of the most recognized indicators of the USA stock market. Financial news organizations around the globe report its daily performance as a quick snapshot of market sentiment. Now, here is the exciting part. Did you know that you can compare the performance of each Dow Jones company against the index itself? If a company consistently outperforms the Dow Jones over time, it may be creating value above the market average. It is exactly the kind of quantitative analysis I've been developing using Python and data science. Instead of simply looking at stock prices, we can measure which companies truly outperform the market using real financial data. So let's begin our analysis. Now guys, here is the Google Colab or Google Collaboratory. It's a free tool from Google that allows you to write and execute Python code directly in your browser. It's run in the cloud, requires no local installation, and provides access to powerful resources such as graphic processing units or GPUs. It's widely used for data science and artificial intelligence. So let's begin analysis. In this code or um, in this algorithm, I use some libraries from Python, iFinance, Pandas, Matplotlib, Datetime, NumPy. It's everything. All this name I said is a tool for from data science. So let's understand. Is there? the first analysis. Dow Jones company stocks 30 days performance comparison. Now let's do other one. Let's try to understand Dow Jones components. This is Portuguese versions. Here's English. Last 30 days, first analysis of Dow Jones. I made three different analysis because I was trying to get the best, and I get the best in the 30 time. So let's try to understand what the algorithm said for us. Uh, Let me see. This is a fuzzy logic. Um, so let's continue. Can fuzzy logic identify the best Dow Jones stocks? When most investors analyze the stock market, they usually ask one simple question: which stocks delivered the highest return? But is that really the best way to evaluate investment? Imagine two companies. One gained 30% over the last month, but experienced huge price swings every day. Another gained 16% with much smaller fluctuations. Which one would you prefer? Most investors would probably choose the second because it's delivered a strong return with much less risk. That is exactly what this analysis is about. Instead of ranking companies by return alone, I used fuzzy logic to evaluate every company in the Dow Jones Industrial Average over the last 30 trading days. The objective was to identify not only which stocks outperformed the index, but also which ones did so more consistently. The Dow Jones itself returned 5.78% during this period. That became my benchmark. For every company, I measure its total return, how much is outperformed or underperformed the index, and its daily volatility. Those variables were then combined into a fuzzy inference system that produces a score between 0 and 100. Uh, why, why use fuzzy logic? Because financial markets are hardly black and white. A stock is not simple, good or bad. It may be slightly better than the market, moderately better, or identically better. Fuzzy logic allows us to model this instantly by assigning gradual classifications then or rigid categories. So now let's look at the results. The highest rated company was Home Depot with a fuzzy score of 91.6. It's returned just over 6 10% outperformed the Dow Jones by more than 10 percentage points while maintaining relatively low volatility. According to the model, it offered the best balance between return and risk. Next come Merck, Johnson and Johnson, IBM, and Sherwin-Williams. All of them significantly outperformed the index and earned classification of strongly above. One result deserves special attention: IBM. It was actually the best performing stock in the term of raw return, gaining nearly 29% during the month. However, it did not receive the highest fuzzy score. The reason is that IBM also had the highest volatility among the top performers. The model recognized that although the return was exceptional, it's come with considerable more risk. This is exactly why physiology is useful. It evaluated both reward and stability instead of focusing on performance alone. On the other hand, the weakest group was dominated by technology companies: Microsoft, Google, Amazon, Salesforce, Disney, and Cisco, all underperformed the Dow Jones. This suggests that during these 30 trading days, investors favored sectors such as healthcare, industrials, and financial rather than large technology companies. While this does not establish a long-term trend, it doesn't provide evidence of a short-term sector rotation. Overall, this analysis demonstrated that simple ranking companies by return can be misleading. A stock that earns the highest return is not necessarily the best investment if that return comes with excessive volatility. By incorporating both performance and risk into a single fuzzy score, we obtain a more balanced and realistic assessment of investment quality. So, if you enjoy this kind of quantitative analysis, consider subscribing to the channel. Every week we'll explore practical explications of Python, machine learning, and quantitative finance to better understand financial market and more informed investment decisions. Thanks for watching and see you in the next video. Bye bye.